Hey guys, welcome to another video. Today I will be starting a new series on international macroeconomics. I'll be working off the second edition of the Robert C. Feenstra International Macroeconomics book. I've provided a link in the video description where you can go to Amazon and buy the book if you enjoy the video series. And yeah, let's begin. And before I do begin, I think it's really important to actually sell you on what the course is going to help you to understand and how it's going to help you in your day-to-day life. Because sometimes some students, and actually a lot of students, don't really like economics, whether they're forced to study it as a mandatory elective or they are studying it as a program. They continue to not like it simply because, again, there are some quantitative based concepts that need to be understood, and if you're not taught properly, it can become very challenging. So really the overarching principle of international macroeconomics is to understand the FX market and the bond market. Now, the FX market is the foreign exchange market. It's where currencies are bought and sold. Whereas the bond market, you already know what a bond is, and that's really, the bond market is where those bonds are sold, whether they are government bonds or corporate bonds or junk bonds, right? And so it's that interaction between the two and how that impacts the overall macroeconomic economy. Now, you probably are more interested in the equities market where stocks are sold, but you will see that the bond market is 3 times as large as the equities market, and it is much more important to the overall global economy. So this course will provide an intermediate perspective on those 2 key markets. If you are going into finance, it is a very important concept to understand, and if you're going into economics, there are some models that you need to understand in order to really extrapolate and understand different changes in currency values. Okay, so let's begin. So a quick overview: international macroeconomics is devoted to the study of large-scale economic problems in interdependent economies. It is macroeconomic because it focuses on key economy-wide variables. And it is international because a deeper understanding of the global economy emerges only when the interconnections among nations are fully considered. And so the key buzzword in probably many years that you've heard right now is globalization. And so as globalization has taken hold of the global economy, the interdependence upon countries has increased. And so what event might occur in one country, it will spill over into another country, even though that domestic economy might not have experienced that domestically. There are a lot of times when some countries will export their crises to another country simply because of policy decisions, and so we'll take a look at that later in the book. Now, the unique features of international macroeconomics can be reduced to 3 elements: money, finance, and policy. Money looks at currencies, and there are 150 currencies in use today. Finance looks at the access to international capital markets, the influence of external wealth, and how changes in currency might impact the overall asset values of a country. In addition to policy, which is the reaction by government or the central bank, and the failure to respond correctly. There are many historical instances where a country has failed to respond in the correct way. The central bank has failed to respond to certain changes in the economy, and all of a sudden a recession might emerge. Okay? So let's look at foreign exchange. Countries have different currencies, and a complete understanding of how a country's economy works requires that we study the exchange rate. Because products and investments move across borders, fluctuations in exchange rates have significant effects on the relative prices of home and foreign goods and services. So I'm a Canadian resident, and not now, but probably 5 years ago, I would frequently go down to the US and buy goods in the US because our exchange rates were close to 1-1, and the prices in the US were significantly lower. Whereas right now in 2017, the exchange rate is 1 to about 0.7. So 1 Canadian dollar is about 70 US cents. So it is significantly weaker. And so the incentive to go into the US is less now because, prices with that 30% premium all of a sudden probably equalize. And so what you see is that really it influenced my consumption behavior, the exchange rate between the US dollar and the Canadian dollar. And this is a key important concept that will influence different economies' performance as exchange rates change. It will influence the price of goods and therefore overall foreign demand, whether demand increases or decreases. Now, based on such observable differences in exchange rate behavior, economists have divided the world into two groups of countries, two key groups. There are more, but we'll focus on these two key ones. There's the fixed exchange rates, where the exchange rate is pegged at a certain level. So, say for example, the U.S. and the Canadian dollar. If the Canadian government felt that, okay, you know what, to stimulate that consumption in the U.S., we're going to peg it at 1-to-1. Then, that exchange rate doesn't deviate from one, and that provides a lot of certainty. Or floating exchange rates, where the supply and demand of the market influence the overall value of that exchange rate relative to whatever it's being traded with. Okay. Now, changes in exchange rates affect an economy in two ways. It can cause a change in the international relative prices of goods, or it can change in the international relative price of assets. These fluctuations in wealth can affect firms, governments, and individuals, and whatever decisions they're making. So we talked about international prices for assets. Say, for example, you are a Canadian resident and you bought a property in Florida. It's a vacation property. Now, let's look at what has happened in the past few years. The Canadian dollar has depreciated against the US dollar. And what that means is essentially it has gotten weaker. And so a US dollar can buy more Canadian dollars now than before. Well, if you bought that US assets 3 years ago when the Canadian dollar was equal to the US dollar, and you held that US denominated asset, 3 years later, today, that asset is worth more simply because if you were to value that in Canadian terms, you have to add an additional 30% because of the exchange rate. And so that will influence your overall decision. Say, for example, you're looking at your kids who are going into college, and you're like, okay, we can decide on college A or B. A is much more expensive. Well, because of this change in wealth, I can sell the house, make much more money than I really expected, and use that extra money to then put my kid in the more expensive. So it influences your decisions as well. And so that's what fluctuations in wealth can do for firms, governments, and individuals. So let's look at two examples illustrating this. So in the mid-2000s, Volkswagen blamed the rise in the dollar-euro exchange rate for declines in U.S. auto sales. So in the mid-2000s, the Eurozone was performing very well, and the euro appreciated in value relative to the dollar. So what happened is that the euro could buy more dollars than before. And so in prices terms, so say for example, Volkswagen is a European producer. They produce some of their cars in Europe, and so when they send those cars to the United States, relative to prices a few years ago, as the euro strengthens in value, the price of those Volkswagen vehicles also increases, and therefore sales fall. Now, for wealth, Eurozone countries held about $200 billion US dollars in assets at the end of 2002. And they were also worth 200 billion euros in 2002 because 1 euro was worth $1. A year later, because, as we talked about in the mid-2000s, the euro increased in value relative to the dollar, those assets were worth only 160 billion euros, when a US dollar was worth only 0.8 euros. These assets were still priced at 200 billion US dollars, but in euro terms, when accounting for that change in the exchange rate, the assets actually fell in value. Okay? So what about an exchange rate crisis? Well, in an exchange rate crisis, a currency experiences a sudden and pronounced loss of value against another currency following a period in which the exchange rate has been fixed or relatively stable. In some cases, the crisis leads to governments declaring default. So once again, let's look at the example of you buying a cottage or a summer home in Florida. Now, you take out a US dollar loan because you're buying that home in the US, and you earn in Canadian dollars. Well, if the exchange rate between the US dollar and the Canadian dollar all of a sudden experiences a exchange rate crisis, and the Canadian dollar depreciates so much that all of a sudden it's worth only 10 US cents, all of a sudden you'll probably default on that US denominated mortgage because you can't really afford those mortgage payments relative to with your current earnings in Canadian dollars. That's the same thing for governments, where governments hold foreign currency denominated liabilities, and so their domestically earned, domestic currency, whatever they earn, if they can't exchange rate to pay the foreign liabilities, and there is a currency crisis, then all of a sudden they are more likely to default. At that point, then they can appeal for help from the International Monetary Fund, the IMF, or the World Bank, which will extend them a loan and kind of help them stabilize their currency in order to meet future external liabilities. Now, key facts in an exchange rate crisis. An exchange rate crisis is defined as an event where the currency loses more than 30% of its value in US dollar terms in 1 year, having changed by less than 20% each of the previous 2 years. Okay, so that's very important. Now, what about the globalization of finance? So financial development is a defining characteristic of modern economics. Households' use of financial instruments such as credit cards, savings accounts, and mortgages helps in the development of society. At the national level, a country keeps track of its finances by analyzing its income, expenditure, deficit, and surplus. Once again, bringing it down at your level, income is revenue, what you earn from your salary, your job. Expenditure is what you pay out. A deficit is if you earn $1,000 and you pay out $1,500, you're a net loss, so it's a deficit. Whereas a surplus, if you earn $1,000 and you pay out only $500 in expenses, then you are at a surplus. You have a profit. Okay? At the national level, the income measure is called gross national disposable income, and the expenditure measure is called gross national expenditure. The difference between the two is a key macroeconomic aggregate called the current account. Okay? And the current account can be in surplus or deficit, as we talked about. Okay? Now, the graph over here, this bit of information, where's my mouse? Hello, mouse. Okay, there you go. So this little bit of information here is the US's income, gross national income, and gross national expenditure, okay, for 1990, 1991, 1992, and 1993. As you can see, in 1990, 1992, and 1993, they ran a current account deficit, whereas in 1991, they ran a current account surplus. And so even a country seen as strong as the US can experience a current account deficit, right? It implies then that that country has to meet up the difference by borrowing that difference. And actually, if you look in the following 10 years after that, actually the following 15 years, the U.S. income has not been high enough to cover expenditures in recent years. And so to meet the difference, the U.S. has engaged in financial transactions with the outside world and borrowed the difference, just as households do. Because the world is a closed economy, it is impossible for the world to run a deficit. If the U.S. is a net borrower, the world must be a net lender to the U.S. So essentially, just as if you were to spend $1,500 and earn only $1,000, then you would probably have to borrow money from a friend or put some money on a credit card in order to borrow that difference. So when a country runs a current account deficit, they must borrow that difference from the outside world. Now, the economy, there can be no more financial inflows from space. As of right now, no one else can give you money except for the world economy. So if the world economy, if you look at it from the highest level, it's a closed economy. And so if the U.S. is running a deficit, the outside world is running a net surplus. It is a net borrower to the U.S. who is a net lender to the U.S. who is a net borrower. Okay? So now let's look at the expenditure model, the expenditure method. Now, you've probably covered this in earlier macroeconomic courses, but essentially net expenditure equals consumption plus investment, consumption plus investment plus government spending plus net exports, which is the difference between exports and imports. So that's relatively easy to understand. Now, let's look at savings. So savings, is the money that you save. So let's look at it at the simplest form. For you, your savings is the difference between what you earn and what you spend, right? It's simple as that. So when we look at SP, which is private savings, really what you earn for the economy, for consumers, is total expenditure. Really, all of that is what you earn. And then the difference was really what you consume, right? So our consumption minus what we pay out in taxes. So that difference is what we save. And so that's private savings. For government savings, what the government earns is tax revenue. That's their revenue source. Whereas what they spend is similar to consumption, C, which is G, it's government spending. So the difference between that is government spending, which is SG. The national income savings, total savings, is SP plus SG. So private savings plus government savings. Now countries can finance investment either by savings or acquiring funds internationally. Okay? Now let's expand this formula a little bit and understand it more. So the simple difference now is, this is the formula that we're looking on the previous slide. Y equals C plus I plus G plus NX. Okay, so consumption plus investment plus government spending plus net exports. Now we are assuming that, for simplicity's sake, net exports equates to the current account, so that the interaction with the outside world is simply based on net exports. Okay, so we can actually replace the net exports with the CA variable. Okay, so what would happen is Y would equal C plus I plus G plus CA. Okay, now we isolate for CA on the left hand side. So CA would be here, and we'd move C plus I plus G over and subtract it from Y to isolate for CA. Okay, and so that's essentially what is done in the next line. Okay, now if we expand this formula and just move the negative across, and so we remove the parentheses over here, so it's Y minus C minus I minus G, we can actually isolate for Y minus C minus G, which is total savings, right? And so if you look up right over here, Y minus C minus T plus T minus G to get total savings, we can cancel out the T to get Y minus C minus G, which is total savings. Okay, and so that's what we have here. Y minus C minus G, that's total savings. We can replace that with S, and so the current account equals S minus I, which is investment. And so we can expand that a little bit. So CA equals SP plus SG minus I. So total savings is SP plus SG. So we can expand that and then isolate for SP. So we move everything over. And so private savings can come from investment, from the government deficit, or the current account. So that's essentially the private savings identity, the uses of private savings identity. I've kind of rushed through this, so you might want to take a look at this a little bit, but let's speak to this. So when savings it exceeds investment, then the current account is above zero, and net foreign investment and financial capital outflows for the domestic economy are positive. So when an economy saves more than it invests, that difference will then be sent out of the country. Like, it won't just sit around, it will be put elsewhere, it will be employed in the international markets. So the final line is the uses of private savings identity, which states that private savings can be used for investment, government deficit, or the current account. So if you have $10, or let's go back to that example, you earned $1,000 and you paid out only $500. And say, for example, that you were the only person in this economy. Well, then that difference of $500 is private savings for you, okay, and accounting for taxes as well, right? So that difference is private savings, $500. That $500 can either be invested, it can be used to fund the government's deficit, or it can be used to sent out internationally, which is the current account. And you'd buy, so you would either import goods or export goods, right? And so that's really what the uses of private savings says. Investment, funding the current account, or the government deficit. Okay, now what about international wealth? We talked about the value of assets changing relative to exchange rates and how that influences decisions. Well, that overall is the total wealth. So total wealth equals assets minus liabilities. From an international perspective, a country's net worth is called its external wealth, and it equals the difference between its foreign assets and its foreign liabilities. Positive external wealth, they are a creditor nation, they lend out, and if the negative external wealth, they are a debtor nation, and so they actually borrow money. Okay? So changes in a nation's external wealth can result from imbalances in its current account. External wealth rises when a nation has a surplus and falls when it has a deficit. Okay, so if you have a current account surplus, that additional cash increases external wealth because that cash will be sent out. If you have a deficit and you need to borrow to meet the difference, then you are selling probably external assets to finance that deficit, right? And so all of a sudden, external wealth falls. One factor to account for is capital gains. So external wealth can be affected by gains or losses on investments. And so we talked about this already with exchange rates, but also with the changing in the value of that capital asset. So in addition to changes in exchange rates, external wealth doesn't stay the same. It changes over time based on the relative valuation of whatever asset is being held. So external wealth may also change due to changing value of liabilities. So if, say for example, you have a bond that you just issued to the world market, right, capital markets, and interest rate change, then the overall price of that bond will either increase or decrease, and that will affect the overall liability, the value of the liability. Okay? So, globalization. We already talked about it being a key word. Now, globalization is often viewed as a technological phenomenon, which is a process driven by innovations in transport and communications, such as container shipping and the internet. Now, there are three groups of countries. There are the ones that increase in financial openness So there are three groups of countries. There are advanced countries, emerging markets, and developing markets. Now, these graphs over here, they just kind of show two key factors kind of to compare the difference between these three groups of countries. Now, in financial openness, the advanced countries are the most open, and that's why they are growing by the most, whereas developing markets, which is the kind of the lowest of the three countries, they are the least open, and therefore they are limited to access in the capital market space. Whereas financial transactions, the same thing, because advanced countries are most open, they have most access to financial transactions, okay? So the three countries are advanced countries, which are high levels of income per person and well integrated with the global economy, and that would be the US. Emerging markets are middle income countries that are becoming more integrated into the global economy, and that would be probably Brazil or BRICS, the BRICS is Brazil, Russia, India, and China. And then developing countries, which is low-income countries that are not yet well integrated into the global economy. And so we can look at, countries in sub-Saharan Africa, or where countries really don't have that openness to the economy, and so they are suffering. Okay? So default risk internationally, and this is something that we'll look at especially later on as you look at different interest rates and analyzing interest rates. Now, defaults highlight a peculiar risk for international creditors. Sovereign governments can hurt creditors in many ways to discourage full repayment. This is reflected in the country's credit risk rating. The difference between the interest paid on a safe bond and the bond issued by a nation in question is called the country risk. So say, for example, essentially what this means is, say, for example, you are country A and I am country B. Country A is incredibly risky and country B is incredibly safe. Okay? Now, if I issue a bond, it's considered a very safe bond because I am a very stable country. And so if my interest rate on the bond, which the market accepts, is 1%, then that is the safe interest rate. Now, you as country A are much more risky, and when you issue a bond, the economy and the global economy and investors need to be compensated for that risk, so they'll be asking for a higher interest rate. And so the interest rate that the market wants is, say, 5%. So your bond, the lowest you can go is 5%, whereas mine, the lowest I can go is 1%. That difference of 4% is the country risk. Okay, relatively simple to understand. And so looking at institutions and economic performance, so just relative comparing the average income per person relative to institutional quality as a certain country, whether it's developing, emerging, or advanced, as there is higher income per person, the quality of institutions also increases. Whereas institutions and income per capita volatility, as volatility increases, the institutional quality decreases, and therefore, developing markets are much more found in that area. And so you can see here by the little green dots, that's developing markets, whereas the blue dots are the advanced markets. So in the previous case, I am the blue dot and you are the green dot. And so in graph A over here, institutional quality is worse with lower income, and so a lot of the green dots are in that side, whereas the advanced economies, the blue dots are higher up with higher average income. For the standard deviation of growth rates, so the overall volatility, the higher volatility is associated with the green dots, developing countries, whereas lower volatility and higher institutional quality is associated with blue dots, the advanced economies. Now, we see that better institutions are correlated with more income per capita. A government that is unaccountable, unstable, ineffective is unlikely to encourage commerce and innovation. And we also see that better institutions are correlated with less income volatility. This may reflect the unpredictability of economic activity in poorly governed countries. Now, looking at the two key groups that we talked about for exchange rates, there's the fixed and floating exchange rate system. Those are the two key overarching groups. Now, looking at this little diagram, as of 2008, there were 123 countries fixed and 69 countries floating. So you can see that even though a lot of people associate floating exchange rates with much more stable and developed countries, there were a lot more countries that depended on fixed exchange rates. And this is a big discussion later on in the textbook, in which we'll cover regarding, the benefits and downsides to each of these systems, okay? So the two broad categories of exchange rate behavior are fixed regimes and floating regimes. Some have sought to simplify their transactions through the adoption of a common currency, which is shared with shared fiscal responsibility. And the common example is the Eurozone with the euro. There are a lot of countries that share one currency, and that means that they have to share fiscal responsibility, while others, especially in South America, have chosen no policy control through the process of dollarization, where they simply substitute their domestic currency with the US dollar in order to provide that stability. Okay, so that's pretty much it for chapter 1. As always, if you are interested in learning more about the course, then please buy the book. I've provided the Amazon link in the description. This is the 3rd edition that you can buy. That's the link to the 3rd edition. And also, if you're interested in investing in the finance or interested in just getting involved in the overall industry of finance or economics, I do recommend that you check out my Seeking Alpha profile, where I publish a lot of research on different companies and economies. And I actually made my bread and butter early on when I was publishing my research on macroeconomic analysis. So I've provided a lot of recognized research with regards to developed markets. So please check those out. Other than that, please like and subscribe to my channel for more videos. If you did enjoy this video, please leave a comment below. If you have any criticisms, please nicely let me know what I can improve on, and hopefully I can offer better videos in the future. Have a great day, guys.